G'day and welcome to this week's video. My name is Rowan and I'm a financial advisor with Consorting Private Wealth. During our day-to-day appointments, there are a number of questions that we get asked as advisors in relation to superannuation, and we understand that it is a complex field and it is quite difficult to navigate at times. So I thought this video would cover off the key questions or one of the main questions we get asked in relation to superannuation. So hopefully the information can be of value to our viewers on this channel. Now, the main question we get asked as advisors is how much do you need to retire? So according to the statistics from the Association of Superannuation Funds of Australia, so ASFA, they've come up with a figure being a couple requires savings of approximately $640,000 if they wish to enjoy what's considered a comfortable lifestyle in retirement. For a single person, that figure falls down to $545,000. Next question being, how is my super tax? So broadly speaking, contributions are categorised as either concessional or non-concessional contributions. Now, concessional contributions are considered your employee contributions or contributions that you make personally and wish to claim a tax deduction for. So that is salary sacrifice. Non-concessional contributions are personal contributions made with after-tax money, so cash sitting in your bank account, for example. A concessional contribution will be taxed at a rate of 15% as it enters the superannuation environment, whereas a non-concessional contribution is taxed at 0%. In terms of your super funds, another sort of, if we break down the tax rates even further, whilst your super fund is in accumulation phase where you're accruing super benefits throughout your working life, there's a 15% tax rate within that applies to any investment returns or capital gains that are triggered within the fund. When in pension phase, when you retired and actually receiving an ongoing pension payment out of these accounts, if it's an account-based pension, the tax rate within that is 0%. So that's the Now the next question is, how can you contribute to superannuation? So the main form of super contribution, the most common one, is your employer contribution. So at the minute, and we're in June 2022, the employee contribution rate, so the superannuation guarantee rate, is currently at 10%. So break that down, if you're earning $100,000 a year, your employer should be putting in $10,000 per year into your super fund to help it grow. Other forms of contribution can be salary sacrifice. That's an arrangement made with your employers at a payroll level to put a portion of your pre-tax income into superannuation. Just be mindful of your concessional contribution caps. At the minute, we can invest up to $27,500 per year within the concessional caps. That also takes into account what your employer is paying as a superannuation guarantee payment. Another way in which you can make a concessional contribution is putting an amount of money that's in your possession now, so in your own bank accounts, have that contributed into superannuation and then applying to claim a tax deduction on that. So we can sort of work in reverse as such and still have that concessional contribution, but by not the salary sacrifice method. So we do that with one-off payments, and that's generally favourable to business owners or farmers when they're doing a bit of tax planning come June and they need to have those tax deductions. So we do those form of contributions there. The other form of contribution is what's considered a personal non-concessional contribution. So once again, with funds in your own name or your own bank account, a contribution into superannuation by that method. The caps are a lot more generous at the minute. You can invest up to $110,000 per year. For low to medium income earners who may be eligible for the government co-contribution, that is where we invest $1,000 of our own money into superannuation as non-concessional, and depending on your level of income, you may be eligible to receive up to a $500 benefit or extra contribution from the government into your super fund. Now, just in relation to contributions, there are age limits and potential work tests that may apply to these contributions. So make sure you have a chat with your financial advisor to determine your eligibility. The next question is, when can you access your superannuation? So the key age that we advise most of our clients is age 65. Now it doesn't matter if you're working or not. At age 65, you've got full access. You can take out your superannuation as a complete lump sum if that's what you decide to do, You can roll it into an account-based pension, receive ongoing pension payments, which is generally the most popular. But we break it down to see what our clients' goals and objectives are. But age 65, there's generally no restrictions there. It is tax-free, and it's at your full disposal what you would like to do with that. You can also access your superannuation benefits once you reach a preservation age, which is leading into age 60. But it's dependent on your date of birth at the minute, but age 60 is generally where most people reach preservation age. And from there you can kick off what's called a transition to retirement pension, where there's limits on how much you can take out per year. However, if you have fully retired after age 60, or after you reach preservation age, you've then got no restrictions. So age 60 and fully retired, you can do what you want with your super, but if you're still working post age 60, so between 60 and 65, there are some restrictions there. Another method in which you can access super, which is a bit of a backup for some, is if you face severe financial hardship or specific medical conditions. So that may be a way to access a portion of your super funds, but there are strict rules and eligibility requirements in relation to that. So the next question we've got is, who can you leave your superannuation benefits to? So it's more of an estate planning question. What happens to your benefits if you were to pass away? Now, most common advice we'll give our clients is to establish a binding death nomination between yourself and the superannuation fund. You can choose a number of different beneficiaries, being your spouse, which also includes same-sex and de facto partners. You can list your children as beneficiaries, whether they're young children or adult children, it doesn't matter. You can list your financial dependents and also people that you've had an interdependency relationship with. So you can actually list specific individuals. If you don't want to be as specific, you can actually nominate your legal personal representative. So essentially, if you were to pass away and you nominated a legal personal representative, in that instance, your superannuation fund will be cashed out and paid to your estate, and then distributed via what is advised or instructed within your will. In that instance, we encourage all our clients to have an updated will and make sure that's reviewed regularly. If you haven't got a binding death nomination in place, your superannuation fund's trustee has a bit of discretion here about who and in what proportions your super fund benefits are paid to. So to avoid those situations, we encourage binding death nominations, and where applicable, if they're non-lapsing death benefit nominations, which means they won't expire. General nominations will tend to expire after 2 or 3 years, but we can hopefully, and if your super fund allows that, get your hands on a non-lapsing death benefit nomination. The next question, and a big part of our job, is how do you make the most out of your superannuation fund? So as an advisor, we're always looking for strategies and opportunities for our clients, and over the journey there's a few key points that we try and pass on. One of those is start your investment in your superannuation as early as you can. So when you're picking up your first job or in your early 20s, don't ignore superannuation. We often say the first $100,000 is the most difficult to accrue, but following that, investment returns and compounding investment returns really make a huge difference. So it'll really ramp up the balance of your accounts leading up through to retirement. So while you're young, personal contributions, potentially take advantage of the government co-contribution. Your income levels may satisfy that criteria. Money in early in summer will make a big difference. Leading into retirement, you may be in a position where you've paid off your mortgage, you've got surplus income. Be smart about that income, pay less tax, consider salary sacrificing, and really focus on those contributions in the lead up to retirement. Another way in which you can make the most out of super is have it invested appropriately. Try not to be too conservative. A lot of people associate growth investing with risk, because with growth investing, and that's investing into Aussie equities or international shares or property, there can be patches of volatility amongst that. But what you'll find over the longer term is reliable, consistent returns. So superannuation is a long-term investment. We try not to time the markets in our business, but we try and encourage our clients to have that long-term mentality. And obviously that is the at the end of the day, that's where we'll achieve the best results. So having good exposure into growth assets is a good thing. Being too conservative, puts you at risk with not keeping up with inflation. Your financial advisor, have those discussions with your advisor. There's tools and resources that we have which will help determine your tolerance towards investment risk and provide investment recommendations to suit. So the two key points: don't ignore superannuation early on and have good exposure to growth assets. But to wrap off here, book an appointment with your advisor. Discuss what goals and objectives that you may have. Don't put superannuation in the too hard drawer or the ignore drawer. Bring it out, have it reviewed regularly, and take advantage of all the incentives and ways in which you can take advantage of the superannuation environment. I hope the video was of benefit. Thanks for watching, and we'll see you next time.